Good morning, it's Jeffrey Cohen, Monday, August 1st. Here to talk about the markets, here to talk about our model. And just a quick introduction, I'm Jeffrey Cohen. I'm an investment advisor representative and president of US Advanced Computing Infrastructures Incorporated, a registered Illinois investment advisor. Here to provide non-discretionary advice to you. Now, this video is not investment advice, but if you're a client, you get the best of our thinking. So that's the benefit. So what I'm here to show you today is the futures on FinViz. I've got model output and happy to show you lots of things. So let's get into it. So it's Monday, August 1st. I guess let's just start with where the market has been. This is the S&P 500. This is a rather fun way that I lay out the S&P 500. Up volume is blue, down volume is gold. And so just change it up a bit for you. So this is the S&P. This is going back to March. You can see how it came down. It made one last giant hurrah. And it made that hurrah on relatively low volume. And then it started its descent. It was at 4,600. It came all the way down to 3,900, bounced up to 4,200, came down to like 3,700, and has been in a steady upturn, right, to 41.24. 41.24 yesterday for the S&P 500. And you can see the volume, it's not bad. So it's hard to tell whether this market is tough or not, right? So that when you see the higher volume days, generally they're down. So high volume down days is not a good sign. But it's hard to say, right? Increasing volume last couple days, markets are up. Who knows what's going to happen? It's pretty funny. It's a pretty straight rise for the past 6 weeks. If we go back and we do a week by week view, and let's say we go back 2 years, you can see the market steady rise from like 3,300 up to 4,700, 4,600. And then it came down. So it looks like it gave back a lot of the gains. It's hard to know whether this is a intermediate move or not. Or is it something else? And so we're not going to try and guess where the market's going. That's not the purpose of this video. The purpose of this video, though, is to show you we were in a very confident decline in the market, which then decided mid-June to turn around and go back up again. And so, you could be right, but you could be broke. And you could be wrong, and you can be rich, right? So lots of people are unwinding their short bets, and they are going long on this market. And far be it from us to say that they were wrong, right? Mid-June, Fed came out, issued their results. The GDP has been negative for 6 months, and the market loves it. I have no idea why that would be, but the stock market loves the fact that we have bad news. Maybe it's because they think 6 months to a year from now it's going to be good news, and they're buying ahead. But I don't know. I think some of this could be summer doldrums. We personally don't believe that the market is in a massive upturn. But just to show you the ridiculousness of it, if you would have bought at the bottom, at the top, you could see how that line goes all the way back to 4,800. This is tremendous right here. I mean, it's just a really nice upturn. So, how the money managers doing? So we look at money managers and a few other economically sensitive sectors of the market. And so money managers, you got about 10 of them down, including Franklin Resources, which does a lot of fixed income, BlackRock, Blackstone. These are big names. Who's up are the small names. Ares, T. Rowe Price, One Main, Main Street, Carlyle Group. Hard to know. It's not sending us a compelling message. Computers and chips. Back to school, right? Need a computer. Need chips. Want to mine some Bitcoin. Yeah, not good today. Computers and chips, B2B, not good today. How about trucking and transport? I mean, a couple of transportation companies are up slightly, but in general, railways, trucking, logistics, down. Okay, so it's Monday, and the market is already telling you it's not going to be a great Monday, right? Pre-market percentage change on what we call the walking wounded, or stocks that have declined a lot in the past few months. Lots of downs, lots of ups, so it's a little bit off. Someone's making a big bet on ATI physical therapy. That's one where they had to stop wages going up. They're the ones that give you the massages, the therapeutic massages, and the physical therapy, like if you have an injury, like for your hand or for your shoulder, or work-related injury, back, whatever, knee. It's also good for after surgery. Let's say you have orthopedic surgery on your knee. You'd go to ATI Physical Therapy, you get your therapy. It's a Illinois-based company. It went through a SPAC, so it was $10. Now it's $1. And a lot of money behind it. I don't think it's going bankrupt, but on the other hand, may not make a profit for a while. And so ATI Physical Therapy at $1 is a 90% decline. And others are slightly up, but not a lot of compelling trade this morning. In fact, that's interesting. It looks like it's actually getting a little stronger this morning. More positives. That's good. Walking wounded. People are making bets on the walking wounded. Specialty retail. That's always a very important sector to look at because this is where people spend money. So you've got declines, pretty good declines. Sports, clothing, the Gap. Increases in Alibaba, Target, Dollar Tree, Macy's, so the big names. Walmart up slightly. Amazon. Amazon, they had their earnings, which were quite bad. And they're up $130 billion. The stock is up $130 billion on bad earnings. So, interesting, you look at the futures, they're actually not bad. They're come si, come sa, right? A C, so. They're not moving. They're not that negative. They're not that, they're just not moving. The place where I think you should look is in bonds. So I think bonds are going to hold the secret to this market. Let's talk about this for a minute. So your 10-year treasuries, if you go back to 2008, let's go all the way back. I don't know how far back this is going to go. 1960s. So you look in the 1960s, and your 10-year treasury was yielding 5% or less, and you were happy. And then came the 60s, mid-60s to late 60s, and the numbers went up. It actually rose up to about 8%, then down to 5.6, then up to 8.3, then down to 7, then up to 16. I remember investing as a child in the early 80s in 13%. I got 13% of my money. I still remember, okay? Now we move to the modern day, and you've seen now a decline from 6 to 3 to 2.3 to 1.6 to 1.3 to 0.6. So you've seen a massive, it's just like looking at a stock. Don't be surprised, people. Look at that decline. So you would say, yeah, long-term interest rates are down, right? And they could go back to zero if you were to look at this like a stock chart. But the reality is, we're starting to see an upturn, okay? And so that would say we could see long rates, going up to 4%, 5%. It's not unreasonable. This is not an unreasonable expectation that you would see long rates go back up. Not unreasonable. It's a pretty nice cross right there. And it's pretty compelling in terms of the slope. If interest rates go up, it changes the whole game. It changes the whole game for this market. This market is based on low interest rates so that companies can borrow money at 5, 6% and basically be walking zombies. The minute interest rates go up to 5%, 7%, 10%, all those zombies go bankrupt. Yeah, I said it. All the walking wounded. I just want to play it out for you, just so you understand what I'm saying here. ATI Physical Therapy, the reason ATI Physical Therapy can lose money for a year or two, and the stock is worth $217 million, but I think they have a lot of debt, is because the debt doesn't cost that much. And they got somebody behind them with deep pockets that probably has a big ego. A big enough ego to go public, right? And so if they had to borrow money at 12% interest rate, forget about it. They're zero right away. A lot of these companies that lose money would be zeros right away if they actually had to pay the proper cost of capital. And then the companies that are left, the larger companies, the better capitalized companies, the profitable companies, will just munch like Pac-Man and eat up all the small companies. And it's fine. It's what happens, especially in a recession. I think it's interesting. So that was one thing I wanted to talk about is interest rates. I don't know where interest rates are going. I really don't. This was something I thought was interesting. This is one-day performance of the S&P 500. And if you look for one day, yeah, Intel's down 9%. Oh, Sky is falling. Procter & Gamble's down. Comcast, AppV, Dexcom I never heard of. Quanta Services I never heard of. But you see a couple companies there down, right? Warner Brothers Discovery at 15, right? So you would say, but look at how beautiful the chart is, right? Oil and gas is up. Amazon and Tesla are up. Risk is up. Google, Microsoft, Apple. Berkshire Hathaway B shares are the number one pick of our CQNS model as of Friday market close. So you look at that and you think, all right, I'm a big expert in the market now because I see that 4 companies went down and a whole bunch of companies went up. Then you go back a week. Intel is still down. Comcast is still down. So it's been a bad week. And also Charter Communication, Meta. Oil's still up. 1 month performance. Now we see over the month, Verizon's down. T-Mobile's down. But yet Intel's only down a tiny bit. IBM's down over the month. AppV is down. Procter & Gamble's down. Go over 3 months. Now over a 3-month time frame, Walmart's down. Procter & Gamble's down. Meta's down. Huge sectors are down. In fact, the whole thing looks about red over 3 months. By the way, the market's been in a recovery since June 15. So 1 month should be green. And look at where it's green. Tesla and Amazon and Home Depot and Honeywell. So it's the large caps that are up. Apple and Microsoft and Nvidia and Texas Instruments and Broadcom and Berkshire Hathaway and Verizon. And so it's the large cap, except for JP Morgan Chase, which is interesting, and except for J&J. By the way, our model likes J&J. It thinks it's coming back. It's consolidating now. It's probably a good bet. Well, I just shared 2 stock picks. I guess I better type them up. BRKB and J&J are loved by the CQNS uprun. So if you're watching, you just got a stock pick there for free. Now we go 3 months again. You see how red it is, right? Because you've been in a bad time. Now let's 6 months. Now for 6 months, energy's been up like crazy. Banking is down horribly. 6 months. Capital markets are down terribly for 6 months. Entertainment is down over 6 months. So this is kind of your recession time. We've been in a recession, 6 months. This is what you see. You see Walmart actually isn't doing that bad. Costco looks great. Energy's been sucking the life out of people's wallets. Utilities are up because in a recession, utilities hold value. Healthcare looks good because people get sick. They got to go to the doctor. Drug companies, same thing. Now let's go a year. What's interesting is over the year, industrials are down. Financial services are down except Berkshire Hathaway. You know, they say one smart person can run a company and lead a company to greatness, and that's Warren Buffett. Plus, obviously, Warren Buffett's entire team. You see a lot of tech is down. So it's just interesting when you look over the day, you're very excited. Amazon's up 10%. Over the year, Amazon's down 25%. So it's a highly volatile situation here in the market. Where are we at today, Jeffrey? How are we going to open today? So you see the futures are slightly red. You can be down a little. VIX is up a little. Energy's down. Dollar's down. Look at Japanese yen. Really recovering. The dollar's weak against Japanese yen. The dollar is weaker against the euro. The dollar's weaker against the Canadian dollar. Dollar is weaker against Great British Pound. The dollar is weaker. Can I say that? The US dollar is weaker. A weak US dollar is good for stocks. So there's a contradiction. Bonds. Bonds are down. Not much. Not much. Down a little. Bonds are actually up. Let's be honest. Look at that. Up, 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 up. Bonds are up. Down slightly today. When bonds are up, it means that yields are down. It means that interest rates are falling, which is generally good for stocks. So interest rates higher, bad for stocks. Interest rates lower, bond prices higher, bad for stocks. So bonds are down slightly. Interest rates are up slightly. Markets down slightly. That kind of makes sense. Crypto, interestingly enough, Bitcoin is holding above 20,000. And it looks like a slight upward trend. So Bitcoin is making a recovery. I don't care what you say. It's so interesting. Love it. Love watching this stuff. So where are you at? I think the market's pretty flat today. The market could go down slightly. Could go up slightly. It's just so hard to know. Wow. Okay, this is important. Amazon cut 100,000 employees from the workforce in a single quarter. Amazon has 1.5 million workers. That's probably as much as the Postal Service. Coinbase is cutting 18% of its staff. Microsoft hiring slowdown. I know I was talking to a company about possibly a long-term job, and they froze everything, froze hiring. Alphabet hiring freeze, which is Google. Robinhood terminated 9%. Twitter cut 30% of its talent acquisition team, which is stupid, but companies are cutting. We're in a recession. Don't be surprised. Anything else interesting here? I'm not sure I see anything. Oh, one thing that's important. New highs to new lows is about 1-to-1. More stocks are above their 50-day moving average than below. We are in a small recovery. I mean, don't be shocked. We are in a recovery. Now, it could be a bear market rally, And let's be honest, a bear market rally from 36.63 to 41.33. It's 470 points. That's about 14%, 13%. A 13% rally in the middle of a bear market is not unusual. It's nice money. It helped your 401k. Everyone feels good. I'm not sure I'd jump back in with both feet, though. It's a 13% rally. I'm not jumping in. I know we're not jumping in. We're not telling our clients to jump in. So let's take a look at what stocks our model really likes. Really likes. Like, just loves them. This is if you were to only hold an individual stock, what would that stock be? So let's dig in a little. So Jeffrey, what stocks would the model pick if it could only pick one stock? I'm glad you asked. I was asking myself the same question, right? Berkshire Hathaway, P&M Resources, which is New Mexico's public utility, Crestwood Energy Partner, which is a master limited partnership in the pipeline business. Ametek, I don't know. McDonald's, of course we know. Pepsi. Marsh & McLennan is an insurance brokerage. Amphenol, I don't know. Algonquin Power and Utilities is a utility. Johnson & Johnson, drug company. I don't remember if they spun off their consumer products or not. There's a bank in there. I don't know how it slipped in. Arthur J. Gallagher is another insurance broker, kind of like Aon. Then you got Coca-Cola. You got Honeywell, Cintas, Graco, I don't know. Icon Energy is another master limited partnership. Lowe's is a gambling company, casino company. Mondelez, food and candy. Illinois Toolworks, B2B, industrial. SCI Investments, I don't know. DT Energy is an energy company. Yum Brands, right? Consumer products. You ever been to Taco Bell? You know Yum Brands. Pizza Hut. Oak Energy, I don't know. Paychex, B2B, small. Lincoln Electric Holdings is like Illinois Toolworks. It's an industrial company. And then you go on, I don't know a lot of these companies. Aflac, supplemental insurance. American Electric Power Company, regulated utility in Washington, D.C. area. Bristol Myers Squibb, drug company. Gilead Sciences, biotech. Duke Energy, utility. NASDAQ is a tech financial services company. ADP, B2B. General Dynamics, right? Aerospace and Defense. Abbott Labs, drug company. Republic Services, B2B and B2C, large non-discretionary. So you go through and you see this is what the model says is consolidating. Lower risk while still maintaining some modicum of return. These are not high expected returns. 4%, 3%, 5%. 4%, 3%, 5%. So you're putting your money in the market to earn between 3 and 5%. Far be it for me to say that that's a good decision or not, but versus the S&P 500, which has lost money, could be very attractive. Another thing that's interesting, so when we look at these stocks, right, why don't we take a look at volume? Who's trading hot? These are profit-making companies. So Getty Images. Getty Images is up 163%. It's trading at 263% of last year's average. Getty Images, Gety, lottery, is down 95% over last year. Holley, is that the automotive parts maker? I'm not sure, but I love Holley Parts. I use their fuel filters for my 68 Camaro. Siga Technology is the monkeypox drug people. Alphabet is at higher volume than normal. Dexcom, Roku, 33% of last year's average price. It's down 67%. Roku's at a high volume. AXT, Lancaster, First Solar, Telephone and Data Systems. Yeah, a lot of these aren't ones that I know very well. United Bank shares is trading like crazy. UBSI. We'll take a look at that. UBSI, United Bank Shares. Stock is up 10%. They must be doing something right. It's interesting. So those are your high volume stocks. Let's see your high variance stocks. E-Home Household Service Limited. That is the highest variance stock, EJH. E-Home Household Service Holdings Limited. It's trading at 375% of last year's volume. Roller coaster? Sure. Landos Biopharma, okay. Cydio Royalties, Brooklyn Immunotherapeutics, BioAlta. Oh, Eros Media PLC has a lot of volatility. Spire Global, and then a lot of biotech. Lottery is gone crazy. Grow Generation variance is up. Now I noticed Grow Generation has hit $5 a share pre-market, so it's coming back. Upstart has a lot of variance. XL Fleet, RCM Technologies, LogicMark, Chegg. So there are some companies out there with a lot of volatility, but take a look at eHome Household Services Limited, and I'm going to take a look at this. I'm going to pull it up right now. EJH, and let's see. This could be a day trader's fantasy. Let's take a look. I don't know if there's anyone's fantasy here. The stock was a $20 to $30 stock. That dropped to $2. That dropped to $1. It dropped to 30 cents. And what's happened is you have these weird high volume days. I don't know what's going on, but extremely high volume days. Somebody loaded the bus in February, and someone loaded the bus last week. So EJ Holdings is a downtrodden stock. It's a walking wounded stock. But with that type of massive volume, the question is, did somebody short 50 million shares or did they go long 50 million shares? That's something I want to watch. That could be a very interesting situation. I like it. EJ Holdings. By the way, you heard it here first. What else is interesting? Let's look at price. What stock is up the most versus last year's average? Cydio Royalties, Getty Images, Siga Technologies. I mean, we knew they were in play. Just the monkeypox people. Antero Resources, oil and gas. That's interesting. Alliance Resource Partners, LP, is up. H&R Block is up. That's one that is worth a look. That one's worth a look. That one's interesting. I have a preconceived notion about that one. So, all right. Lots of ways you can play with the numbers and look at the model. So it's 7:30. Let's go back to where we're at. We're down a quarter point in the futures. Yeah, I mean, markets are down slightly. US Equities. The 30-year bond future is down slightly, but all the other bonds are up. Well, notes, I should say, are up. So interest rates are not really falling, right? Silver's up, gold's up, platinum's up, copper's up, palladium's up. Now, oil and gas is down, which is interesting. How the world market's doing? China's up. Europe's up. Japan's up. Everyone's up. Why are we down? It must be Monday. Time for the U.S. traders to come in and crash the market today. But this isn't necessarily a crash the market day. This is just a slightly betting against the market today. And so, yeah, I don't know. This is so interesting. Well, at least I picked up a few stocks to look at today. I picked up UBSI, EJH, HRB. And whatever else is out there. So, good luck in the markets today. If you like the video, hit the subscribe button. It really helps us. We're not paid to make these videos. And when you hit the subscribe button, it tells YouTube that you like the channel, gives you notifications of when our next video is coming, and it allows them to, or helps them to share the video with more people. Spreads the word. Drop a comment. I like that. You can just say what you're thinking, and a lot of times we'll respond to those comments. And if you check out the website, here's what you're going to find. We are a registered investment advisor and consulting firm. We update a lot of information about the markets. We just updated it this morning. We share a lot of research. We offer quantitative analysis for clients that pay for it. That's how we make our money. And we'd be glad to have you as a client. We run models. We run them on a server. We started our business with a quantum computing algorithm, and we can still occasionally use quantum computers, but we haven't been using it lately, and we're in the markets. So hopefully you enjoyed it, and check out our website, check out our brochure, maybe buy a run, buy a service. We've got our brochure updated June 29th. So you take care now. Good luck. Bye-bye.